G'day Nia, great question. So how much should a business be making in profit before they can do this? This is referring to my tax structures of the Rich, Famous and Wealthy video, which talks around how the wealthiest individuals optimize their tax, protect their wealth and provide themselves with more flexibility in their financial position. Let me give you a little bit of a case study and explain what the kind of criteria are. So we're going to have a look at my tax structure breakdown, which talks through the difference between an individual, a company, and a trust. So an individual has no flexibility in earnings or gains. So basically any income that they earn has to come to themselves, but they have flexibility around their marginal tax rate. Essentially, we've got a progressive tax system, meaning that we've got a tax-free threshold, and then it goes up in tiers up to a maximum of 47%. Also, as an individual, you get a capital gains tax discount, which basically means that maximum you will pay 23.5% capital gains tax, assuming that you've owned an asset for more than 12 months. There's no asset protection and it's simple and cheap. But what we're kind of comparing to is a company where it can retain and pay tax at 25%. So obviously 25 is much less than 47%, but the story doesn't stop there. And there's no CGT discount, so it will pay capital gains tax at whatever the tax rate is. If it's a trading business, it's 25%. If it's a passive investment entity, it will pay 30%. And then, of course, we've got a trust, which basically doesn't pay tax itself. However, it gives us flexibility around how we can distribute income to various individuals in order to take advantage of their marginal tax rate. Now, this is all a little bit confusing until I put it into context. So let me show you how we kind of calculate this and how you can do this yourself. Now, first and foremost, this will depend on the amount of distributable profit that you have available and the other sources of income that you and any of the members in your family unit who you are going to potentially distribute income to have access to. I'm going to show you that. Let's assume that for most people, it's themselves and their significant other. Potentially they might have kids who've got over the age of 18 and aren't kind of out in full employment yet, maybe are studying, not earning incomes for themselves, because we've got to realize that there is basically a opportunity of distribution between the tax-free threshold, so like 0, all the way up to paying an average of 30% tax before we start looking at other structures and entities. So I've jumped onto this website called paycalculator.com.au and I have chucked in an annual salary of $200,000. And what I've now done is I've gone and calculated what is the taxable income and the tax payable for $200,000 of gross income. And you can see on my calculator here, if I take the tax that's payable, which is $60,000, and I divide that by 200,000, it essentially works out to 30%. So, hypothetically, what this means is that you and your partner essentially can have up to $200,000 each a year of income and pay a maximum of 30% tax. So, essentially, what we need to consider is how do we create various tax structures in order to achieve that? Because let's say you've got your business and it's in your name and you're earning 400 grand a year, you can't split that with your partner. And this is where we need to get the tax structures right. So here's a hypothetical scenario of a business that runs through a proprietary limited company, has $1 million in revenue, $500,000 in profit, and it will pay 25% tax or $125,000, which leaves us with $375,000. This 25% is actually a franking credit. So let's say the shares in this company are owned by a family trust. We distribute the $375,000, but we also need to consider the $125,000 of tax already paid. So we actually gross it up to $500,000. Then we choose to distribute $400,000 of that to the individuals. So to John, $200,000. John's going to pay $60K tax, 30%. Jane's going to get $200,000, pay $60K in tax, 30%. They're going to have a net income of $280 grand. And essentially the remaining $100,000 of distribution, we put into a bucket company because a bucket company pays 30% tax. Because if we put that to John and Jane, they would end up paying more than 30% tax, right? So what we now need to consider is basically when we pay it to this company, we pay a flat rate of tax there and any additional amounts if the profits were higher, and then we can invest that money into the bucket company. Now, of course, these individuals have a household expenses, so they've got 200 grand a year. So let's say they're saving 80 grand a year, 28%, and we take that 80,000, we gift it back to the family trust, and we use that as a deposit to go and buy a property, $500,000 property. So the benefit of this is that we've got flexibility in this structure. It depends on the profit of the business. We have control over how we distribute that money, and then ultimately how we then utilize structures to kind of acquire assets and compound our wealth for the future. And the idea is that we pay the least amount of tax necessary, which basically is capped at 30% in this particular strategy. And there's also some other ninja strategies that we can implement to pay less tax than that using other entities and structures. So as a general rule of thumb, we're talking about $200,000 in profits. However, there are circumstances whereby setting this stuff up is either going to provide you with more asset protection, so you would do it sooner, or you want to do it preemptively as you work towards hitting these targets so you don't have to worry about restructuring later. It's very important that you do get tax advice from a specialist tax advisor. So if there's something you'd like to get some help with, feel free to jump on the link in my bio. Happy to help you. Any questions, let me know in the comments.